This conference will now be recorded.
Hi Bhakti. Hi everybody.
Yeah, hi Rashmi.
Bhakti, you got the presentation rights, no?
I'm not the screen. Can everyone see the screen?
Yes.
We will start the session.
Yeah, we can start Bhakti. Let's start.
So, good evening, everyone. Today, the topic which we are covering is on merger valuations. In case of merger valuations, what we are going to discuss today are more the practical aspects which one faces while doing a valuation in case of mergers and demergers. We will not be discussing the valuation methodologies or approaches and what adjustments are required, because those will be similar to what you will do in a normal valuation exercise, and for that it requires a separate session altogether. So feel free to ask any questions during the course of the session. Now, before we get into the valuation aspects involved in merger, first, I just wanted to spend a few minutes to discuss the concept of merger and demerger. Most of us will be aware of it, but we will just quickly take 2-3 minutes to discuss on the same. Now, what is merger? Merger is sometimes also known as amalgamation. Can anyone tell me what is merger? Will anyone like to explain what is merger? Okay. In case of merger, say I've shown it in a picture format. There is A Limited, which is proposing to merge itself into B Limited. In this case, all the assets and liabilities of A Limited will be transferred to B Limited. So A Limited is termed as the transferor company, and B Limited will be the transferee entity. In consideration for the merger, B Limited will issue its own shares to the shareholders of A Limited. A Limited loses its existence. A Limited will not SmithKline Consumer and Hindustan Unilever Limited, Vodafone and Idea Cellular. Now let's look at the second case of demerger. In case of demerger, it is almost similar to merger. However, there is a small difference in case of demerger. A Limited in this case has two businesses, undertaking A1 and undertaking A2. It wants to transfer one of its undertaking to B Limited. Now, in this case, A Limited is not entirely merging into B Limited. Only the assets and liabilities pertaining to undertaking A2 will be transferred to B Limited, and B Limited will in turn issue its shares to the shareholders of A Limited. Here, A Limited continues to exist. It does not vanish. It will stay as it is with the remaining business and with its shareholders. B Limited will now have two divisions, one its own division and undertaking A2. And it will again have two sets of shareholders, its existing shareholders plus the shareholders of A Limited. Now, how does one determine what are the number of shares that B Limited will have to issue to the shareholders of A Limited? So it is based on a share entitlement ratio, which in turn will involve valuation of shares of B Limited. And in case of A Limited, one needs to value the undertaking which is getting transferred, which is undertaking A2, and divided by the equity share base of A Limited to arrive at the value per share of the undertaking. Classic examples of demerger will be IDFC Bank, general insurance business of Bharti AXA into ICI Lombard. Then another example could be demerger of consumer business of Tata Chemicals into Tata Global Beverages Limited. Now, which are the key regulations which one needs to keep in mind while dealing with mergers and demergers, and where does the valuation get triggered? So any merger or demerger needs to comply with the Companies Act provisions, Section 232 to Section 234. Sorry, can people hear me?
I think the network is little unstable now, whether it's at your end or ours, I don't know. But in between the screen is like, freezing. I'm not sure what others are facing.
Just a second.
No, we are facing the same issue actually.
Okay, let me just check the network connection.
You can try, shutting off your video. Maybe that will help.
Okay. So which are the key regulations that one needs to keep in mind while dealing with mergers and demerger valuations? One of them is the Companies Act 2013. Specific sections are Section 230 to 234, read with its underlying rules. Under Companies Act, one needs to arrive at the share exchange ratio or the share entitlement ratio based on the valuation carried out by a registered valuer. If it is a listed company, if there is a listed company involved in a merger or a demerger, one needs to also look at the SEBI regulations, specifically the SEBI Master Circular of 23rd November 2021, the listing regulations, NSE circulars 2nd November 2021, NSE and BSE circulars of May and June 2017 respectively. We will deal with the specific aspects of these circulars on how it impacts the valuation in the subsequent slides. Other regulations are the stamp duty. On merger and demerger, one needs to pay stamp duty, which is based on the value of shares allotted or value of the immovable property. Another key regulations are the Income Tax Act, where it lays down the specific provisions dealing with the taxability in the hands of shareholders and the company. In terms of FEMA regulations, under the FEMA regulations, if there are issue of shares by a transferee company to a shareholder who is a non-resident, there are certain conditions laid down as to saying that the scheme has to be approved by NCLT, and in case of listed companies, it needs to be approved by the SEBI. There is a FCGPR form which needs to be filed in which the valuation report issued by the registered valuer will be forming part of the report, forming part of that FCGPR form. Now, as I discussed earlier at the start of the session, valuation approaches and methods which are used for merger valuation are normally similar to what we used in any normal valuation exercise. So widely accepted approaches: income approach, market approach, and the cost approach. Income approach, discounted cash flow method; market approach is market price; comparable companies multiple method, comparable transaction multiple method, and cost approach if it is relevant in a particular case, then either the net assets value method or the replacement value or the realizable value method. Now, once the valuer has carried out the valuation under various approaches, what is that we are attempting to arrive at? So in this case, the attempt is to recommend a share exchange ratio or a share entitlement ratio, and the attempt is to arrive at the relative value. The attempt is not to arrive at the fair value. Now, how do you arrive at a relative value? So in case of merger or demerger, generally there are two entities involved, two or more entities involved. So the relative value for each of this entity will be usually derived by using similar approaches to the extent possible, similar methodologies, and applying similar weightages to the value arrived at under each of the methods. However, there are few exceptions. Say, for instance, if there is a merger of an investment holding company into an operating company, for operating company, you may use DCF method under income approach. You may use market price method under market approach, comparable companies multiple method under market approach. However, for an investment holding company, we will not be able to use a DCF method under income approach, or we may not be able to use a comparable companies multiple method. We will be using a cost approach whereby the value of the underlying investments will be captured at the fair value. Second instance could be a merger of an unlisted company into a listed entity. In case of listed company, you will have the market price data, and therefore you will be able to use market price method under market approach. However, for the unlisted company, we may not be able to use a market price method, but you may end up using comparable companies multiple method. Similarly, for a division, demerger of a division into a listed company, the division of a listed entity is not separately quoted on any stock exchange. So even though the division belongs to a company which is listed, but the division itself, you will not have a market price. And in such case, you may end up using comparable companies multiple method for the division, but for the listed company, you may use market price method. Now, there have been various judicial decisions in the past where it has been held that it is fair to use a combination of methods. The most famous cases of Hindustan Lever employees versus HLL. One should always read this case laws as this case laws gives a base as to where this combination of methodologies and applying weightages has evolved. Second judicial decision, which is also important as far as the valuers are concerned, is the courts have held that exchange ratio will not be disturbed by courts unless it has been objected and found to be grossly unfair. Two famous decisions here are of Mihir Mafatlal versus Mafatlal Industries and Dinesh Lakhani versus Park Davis in the case of merger of Pfizer and Park Davis. Here, I've just given a small example on how the share exchange ratio is derived and a share entitlement ratio is derived. So on the left side, if you can see, there's merger of company A into company B. The valuation has been carried out under the three approaches and the value per share has been arrived at. We have, in this example, if you see, there is no asset approach has not been used. So 0% weightage has been given to both company A as well as company B. And income approach and market approach has been given similar weightages. So what we are trying to say is we have used similar approaches and similar weightages to arrive at the relative value per share, and then value per share of company B divided by value per share of company A will give you the exchange ratio. And the way to put it in the report will be for 2 equity shares of company B will be allotted for every 5 equity shares of company A. Similarly, for a share entitlement ratio, one needs to value the undertaking. It's exactly similar, except that here there is an undertaking which needs to be valued and which will be divided by the equity share base of company A to arrive at the relative value per share with respect to that undertaking, based on which the ratio is given. Now, there is one more aspect that one needs to keep in mind, where there is either a merger of an unlisted company into a listed entity, or there's a demerger of a division of an unlisted company into a listed company, and listed company issues shares to the shareholders of unlisted entity. As per the SEBI Master Circular 23rd November 21, there they have said that In such cases, one needs to also look at the price per share of the listed entity based on the ICDR pricing. As per the latest SEBI ICDR regulations, the price of equity shares should not be less than higher of 90 trading days volume weighted average price preceding the relevant date or 10 trading days volume weighted price preceding the relevant date. Now, what is relevant date? There is a relevant date definition which has been provided in the ICDR regulations, but that is specific to preferential allotment. The SEBI Master Circular has provided that relevant date for the purpose of computing the price of a listed company in case of merger is the date of the board meeting in which the scheme is approved. So say if the board meeting is today, 25th, then one should calculate 90 trading days volume weighted price up to 24th Feb. Similarly for 10 trading days. Now what happens if the ICDR pricing is below the relative value? If the ICDR price of the listed entity is below the relative value, then one needs to take the relative value per share of the listed entity and compare it with the relative value of the unlisted entity. But if it's a reverse situation where the ICDR pricing is higher than the listed company relative value. So let's look at an instance in the next slide. The valuer has worked out the relative value per share of the listed company at 295 rupees per share. However, the value per share of company B as per ICDR pricing formula comes to 330. Then what happens in such case? In such cases, one needs to compute the ratio based on the ICDR pricing of company B, which is 330 divided by 118, which is the value per share of company A, and then recommend a ratio. Any questions so far? Shall we move ahead? Okay. Now, next step, once you have done the evaluation, once you have done your workings, you have arrived at the relative value per share, the next step is to prepare a report. Now, the report has to be, the content of the report has to be in line with the ICAI Valuation Standards 2018. However, what has happened over the years of practice, there is a practice which has evolved that the valuation workings are not provided into the valuation, into the share exchange recommendation report. Now it has evolved over a period of time. Previously, prior to 2017, only the exchange ratio was included in the report. Post 2017, in May 2017, there was a circular of NSC as well as BSC that they said you need to disclose the table which is put onto the slide, whereby you give the value per share under each of the methods which you have adopted and the relative value per share which has been arrived by you, based on which the exchange ratio has been recommended. So if you look at the reports today, 99% of the reports on merger demerger will just have this table and the exchange ratio. The detailed workings do not form part of the report. However, the valuer is required to provide summarized valuation workings separately to the companies for submission to the stock exchanges, SEBI, and regional director. Also, one should keep in mind that if a particular valuation approach is not used while carrying out the valuation, the rationale for the same needs to be clearly provided in the report. Also, when one is putting the table, if say one of the approaches is not used, you may write not applicable and you may have to give a rationale below the table as to why that approach is being not used. Now, which are the other aspects which one may come across? Sometimes, in case of, mainly in case of listed companies, sometimes two valuers are appointed. Here again, there are two practices. One practice is where transferor company will appoint one valuer, transferee company will appoint another valuer. And there is another practice where both the companies, transferor and transferee companies, will appoint two valuers jointly. Now, how does one deal with such cases? Say they look at the first instance, where the transferor company has appointed one valuer and the transferee company has appointed other valuer. A Limited has appointed ABC Limited. B Limited has appointed PQR Limited as a valuer. Now, ABC Limited in that case will have to carry out the valuation of both entities, A Limited as well as B Limited. Similarly, PQR Limited, which is another registered valuer, will have to carry out the valuation of A Limited and B Limited both to arrive at the ratio. Now, in certain cases, the companies insist that they want a joint report. What do you mean by a joint report? Joint report is that both the valuers sign on the same report. And in some cases, both the valuers issue separate report. One thing which is very critical in this case is there has to be a consensus on the ratios. So the methodology used by the valuer may be different. The value per share that one may arrive at could be different. But the ratio ideally should be same. Now, what happens if there are different ratios given by both the values? So there's a classic case, which is an old case, I don't remember the year, of Hindustan Ciba and Sandoz India merger, where the companies had appointed 3 valuers. All 3 valuers arrived at a different ratios. The board in turn averaged the 3 ratios and said that this is the ratio which they have considered for merger. This was objected by the minority shareholders, and finally the court appointed another valuer to arrive at a ratio. So it is very critical in case of mergers that both the valuers should have a consensus on the ratio that is to be recommended. Further, in case of listed companies, there is a requirement of a fairness opinion which needs to be provided by a SEBI registered merchant banker, which will say that he has reviewed the workings of the registered valuer and he has carried out his independent analysis, based on which he is of the opinion that the ratio which has been recommended by the registered valuer is fair. Now, how does one practically deal with such case? So generally, once the registered valuer has done the valuation, the report is to be shared directly with the audit committee and the board of directors. He cannot share these workings with anyone else. However, in wherever there are listed companies and a merchant banker is involved, there is an instruction from the company to the registered valuer that he is requested to share his workings with the merchant banker and hold discussions with the merchant banker, and also communicate his decision to the merchant banker to enable the merchant banker to give his opinion on the fairness of the ratio. So practically, though there is no laid down principles as to how, there are no principles laid down as to how this has to be done, practically people have been following this methodology. One point needs to be kept in mind that the registered valuer and the merchant banker needs to be independent of each other. They should not have any conflict of interest. They should not have any common directorship between both of them. They should not have any common partners. Now, what is the process that one needs to follow for submission of the report to the listed entities? So one is the registered valuer is requested to provide a presentation to the audit committee, where the registered valuer will explain the methodologies that he has adopted, what is the value per share he has arrived at, how he has arrived at, what are the multiples he has used, what are the discount factor he has used, what are the comparable companies that he has considered while arriving at the valuation, and ultimately the share exchange ratio. And the report of the registered valuer needs to submit that report to the audit committee. The audit committee in turn will submit their recommendation to the board of directors. Okay, after this, there is also a meeting of the committee of independent directors, where the registered valuer is required to again make a presentation. And the committee of independent directors will submit their recommendation to the board. As I mentioned earlier, in case of listed companies, it's a requirement to obtain a fairness opinion of a SEBI registered merchant banker as well. The board of directors of the listed entity will take into consideration the report submitted by audit committee, the independent directors, and the fairness opinion before giving their final approval to the scheme and the share exchange ratio. Now, there are certain additional points one needs to keep in mind where there is a merger demerger involving listed company. All registered valuers should keep this in mind. This is come from the NSE circular 2nd November 2021. Some of the points have direct implication on the valuation which needs to be done, and otherwise, and some points are more about procedural, but the valuer needs to be aware of it, as it may result in a practical difficulty at the company level. So the first one is that the board of directors are now required to consider the scheme of amalgamation within 7 days of issuance of a valuation report. So if you have issued a valuation report, say today, the board of directors needs to consider the scheme within 7 days of the today's date. Otherwise, the valuation report will have no value and the company will have to get a new valuation done. Second is within 15 days of the approval of the scheme, the documents along with the valuation report needs to be submitted with the stock exchange. And here they have made it very clear that if the documents are not submitted within 15 days, one will have to again hold a board meeting to seek a fresh approval for the merger based on fresh financials and a fresh valuation report. So this was never there earlier. It has been introduced from 2nd November 21. In fact, prior to 2nd November 21, there were many cases where during lockdown it so happened that valuation report was obtained and the board approval was obtained, but the documents were not submitted to SEBI for all stock exchanges for almost 3-4 months. And in all those cases, the stock exchanges came back to the companies to say that you need to get fresh valuation done. And after that, the circular has come in where they have laid down clearly that this needs to be followed. Now, the third point is very critical. They are saying if there is an unlisted entity involved, the audited financials of the unlisted entity should not be older than 6 months at the time of submission of the scheme to the stock exchange. So if you're submitting a scheme on say 30th April 2022, the audited financials of the unlisted entity should be for the period ended 31st October. Practically, whether it's easier to obtain the accounts as on, so generally people follow June, September, December, March. How easy or how difficult it will be to get this 31st October for unlisted entities, except especially in cases where there are a lot of businesses, lot of subsidiaries involved, will be a challenge. In addition to it, they are saying those audited financials of 31st October will also have to be considered for the purpose of valuation under income approach. So they are saying for income approach, so more specifically to say discounted cash flow method in practically most of the cases. So what happens for valuation under market approach and asset approach? Here they have laid down additional criteria saying that for asset, for other than income approach, which means asset approach and market approach, the period under consideration for valuation should not be older than 3 months. So that means if I am doing a valuation date or valuation as on a valuation date of 30th April, my accounts should be as of at least 31st Jan or later. I can't use 31st December accounts. Another issue which is there is when you look at the circular, this point has been mentioned separately. So whether this applies to listed only to unlisted entity or to listed company is not very clear. The conservative view which has been taken is this applies to both listed and unlisted company. Now, unlisted company, I can understand you may be able to somehow get data as on 31st Jan. For unlisted companies, very difficult to get this data, and there are challenges around this. So one needs to be very careful with the last 2 points. If someone does not, if any valuer does not follow this, the valuation report will be rejected and a fresh valuation will have to be carried out. Now, as per the SEBI master circular, there are certain cases where report is not required. Now, which are those cases? Primarily, there are only 2 cases which they have laid down, which are more about merger of wholly owned subsidiary into a listed parent company or demerger of an undertaking of a wholly owned subsidiary into a listed parent company. Now, in both these cases, the listed parent company is not going to issue any shares. Therefore, there is no change in the shareholding pattern of the listed transferee company, and therefore no report is required. But I have seen in some cases, some of the companies are still obtaining a report which will just say that there is a merger of wholly owned subsidiary into a listed parent company. However, no shares are being allotted because it's a wholly owned subsidiary, and therefore no valuation is required. But I think so there is a SEBI master circular which is very clear saying that the report is not required. Asim, I'll take your point later on. I've covered it in the later slides. Now coming to a situation where the valuation where the report is required to recommend a ratio, but a valuation exercise is not carried out. One such classic example is of a demerger. So I will explain it through the picture which I have put on the slide. So there is A Limited, which has two divisions, Division X and Division Y. A Limited proposes to demerge Division Y into a newly formed entity, new company basically. In this case, the new company will issue shares to the shareholders of A Limited. Now, why the valuation is not required? New company does not have any business. It's just newly formed. And the existing share capital of new company will be cancelled pursuant to the demerger. And new company is going to have the same set of shareholders which A Limited has. The shareholding pattern will be exactly similar. All the shareholders of A Limited will hold shares of NewCo in exactly the same ratio as they were holding shares of A Limited. This is generally called as a mirror image shareholding or a plain vanilla demerger case, and valuation is not required in such cases. One of the example is of demerger of banking business of IDFC with IDFC Bank. I have put one more example on the slide. There was demerger of pharma business of Aarti Industries into Aarti Pharma Labs, and couple of such cases where valuation is not carried out and a ratio is recommended. Now, how does one recommend a ratio without a valuation? So generally what happens in such cases, the management will have a certain target capital structure which they need for the new company, depending upon the profitability of the business which is being transferred, what is the serviceability of the capital, and on those factors they determine what is the proposed share capital of new company they want post demerger, based on which the ratio is recommended. Now let's look at another instance here. Here we have A Limited, which has two divisions, and there is B Limited, which has its own existing operating business. The proposal here is that A Limited wants to demerge its division into B Limited. Now B Limited, because it's a demerger, will issue its shares to the shareholders of A Limited. Now, can I recommend a ratio without carrying out a valuation in this case? No, because B Limited will not have exactly the same shareholding pattern of A Limited. Here B Limited will have its existing shareholders, plus it will have shareholders of A Limited as its shareholders. And therefore, one needs to carry out valuation of shares of B Limited and valuation of per share of division Y to arrive at the share entitlement ratio. This is a case of non-vanilla demerger. Certain examples are of demerger of cement business of Century Textiles into Ultratech Cement, demerger of consumer product business of Tata Chemicals into Tata Global Beverages. Now, this is an interesting case where we are saying, if you look at the picture, we have an operating company which is held by two sets of shareholders. One is the promoter company and then the other shareholders. The proposal here is that the promoter company will be merged into the operating company. The shares held by promoter company in the operating company will be cancelled, and the operating company will allot same number of shares, which is 20,000 in our example, to the promoters of the promoter company, or to say shareholders of the promoter company. So what is the resultant structure looking like? There is operating company. It has 80,000 shares which are held by the same set of shareholders, and 20,000 shares instead of the promoter company are now directly held by the individual promoters. Now in such cases also, there is no valuation required, and one can just recommend the ratio to say that so many shares will be allotted to the shareholders of the promoter company. This is sometimes also known as collapsing of the holdco structure. A few examples here are of Hero Motocorp, Welspun Corp, and there are quite some cases in this. Now here one needs to keep in mind some factors which are very critical before coming to a conclusion that a valuation is not required in such cases. One is the promoter company which is being merged into the operating company should not have negative net worth. Second is the shareholding or the interest of the other shareholders in this case, which are holding 80,000 shares, should not be impacted, which in our case is not getting impacted. They continue to hold 80,000 shares and they continue to hold 80% stake. Third is that whatever expenses are there pertaining to the scheme needs to be borne by the promoter company or the promoters. And one should refer to the draft scheme to capture this and also take a management representation letter in this regard. One more critical point is that if there is any liability arising on account of any litigation pursuant to this merger, that will be borne by the promoters. So these are a couple of factors which one needs to keep in mind before coming to a conclusion that a valuation is not required for recommending a ratio. Now, we will deal with certain cases which are more on the practical side, or you can say issues or challenges which one faces in case of mergers and demergers. Appointed date. Now, say if I have one merger where the appointed date is of 1st January 2022, and there is another case of merger where the appointed date is 1st April 2022. What should be my valuation date? I have to issue, say, in this case, both the cases, I have to issue the report tomorrow as the board meeting is tomorrow. So what should be my valuation date? Anyone would like to answer? Asim is saying that the valuation date will be same for both. Anyone else has a contrary view? Yeah, so Asim is right. The valuation has nothing to do with the appointed date. What is the relevance of appointed date? The appointed date relevance in case of merger and demerger is more about that the assets and liabilities of the transferor company will be transferred to the transferee company with effect from the appointed date. So if it is 1st Jan, then all the assets and liabilities will be transferred from 1st Jan. If the appointed date is 30th April, then the assets and liabilities will be transferred from 30th April. When I have to issue a report tomorrow, my valuation date will be as of today. I will do the valuation date as of today. So irrespective of whatever is the valuation appointed date, the valuation date will be the date on which you need to issue the report. The second case, generally in case of merger and demergers, there are various synergies or benefits which arise either in terms of operational efficiencies or administrative cost reduction. Whether one should consider such synergies while arriving at the value per share of the transferor and the transferee company. So Sanjay is saying no. Anyone has a contrary view? So Prashant, the date of signing and the date of valuation in case of mergers will be the same. So generally what happens in case of mergers and demergers, say the board meeting is tomorrow. So you will issue the report tomorrow, but the valuation date is one day prior to the issuance of the report. So to that extent, this, because generally in case of especially listed companies, it's very difficult to control the price movements or anything on the day of the board meeting. So the practice has been that if I have to submit a report to the board tomorrow, I will take the valuation date cutoff as of today. So Sanjay says that we should not consider the benefit of synergies on merger demerger. He's right. What we are doing the valuation, we have to do the valuation on an as is where is basis. The synergies or the benefits which are arising are futuristic, is prospective, and should not be considered while arriving at the relative value per share of the transferee and the transferee companies. Sorry, Rashmi, you're not able to hear me. Rashmi, you can hear me? Asim, you can hear me, right? Okay. Let's look at the third thing, value of intercompany holdings. Here, let's take if valuation date is same as report date, then till what date? Just a second. So Devrajan, you have put a question. If valuation date is same as report date, then till what date will the financials be considered for the cutoff? So if you are looking at so it depends, like Devrajan. So there has been, again in this case, there have been two practices. Some firms they say that the valuation they will take the financials as of, say, for in one of the example is the last available financials is say 31st December. But my valuation date, I will say that if I have to issue it today, I will say that the valuation date is as of today, because I will be applying a multiples based on current market prices, comparable companies as well as of the company which is being valued. So according to me, the cutoff financials has no relevance as far as the valuation date is concerned. Ideally, it should be closer to the valuation date, but practically, generally, you will generally get 31st December or 30th September if you are doing a valuation, say, in February. And that should be fine, except in case of the listed companies merger, where the now NSE as well as BSE, NSE has come out with this circular to say that the financials cannot be older than 3 months. So if you look at even if you can draw a reference from even that circular, they are saying that the period under consideration should not be older than 3 months, but the valuation date will have to be as of today. Whether that was what you are asking? Okay. So let's look at the next practical issue which one faces. Say there is a merger of A Limited into B Limited, where A Limited holds certain shares of B Limited, and one needs to arrive at the share exchange ratio. Now, if it is a single method which you are using for valuing both the companies, there is no issue. But say you are going to use DCF method for company A as well as company B, and you are also going to use, say, CCM method for company A as well as CCM method for company B. Then how will you capture the intercompany holdings? Asim, I'll answer that question. I'll just finish this point on intercompany holdings and revert to you. So in case of mergers where you are using, say, two approaches for valuing company A as well as company B, the way we have been doing it is, say, for DCF method, valuation of company A Limited under DCF method, I'll capture the DCF value of B Limited for valuing the investments held by A Limited and B Limited. Similarly, if to arrive at the value of A Limited in the CCM method, I will take the CCM value of B Limited into the valuation of A Limited. So Asim's question was for a plain vanilla case of listed company A merging into listed company B, is it okay to use only share price as the method as long as both shares are frequently traded? So Asim, as far as we have, whatever my experience has been, we have always, apart from market price method, used a second approach, which could either be a comparable companies multiple method or a DCF method to arrive at the share exchange ratio. We have never issued a report based on just the share prices of the two companies, because sometimes the share price may not entirely capture the valuation of both the entities correctly. So at least we have never done it. There may be some firms who may be recommending a share exchange ratio based on just the market price method. Rushi has posted a question. Suppose the division being demerged has very well synergies with current companies, and it will fetch a lower value. The company with the entity will have a lower synergy than the current. Rushi, can you explain your question? If you can switch on your microphone and just.
Yeah, hi ma'am. So my question was, suppose there is an company A Limited which has a division X. So division X is currently having suppose 100% synergy with company A, or very well synergized with company A. On a
Yeah.
standalone basis, the value of the it won't have basically any synergy, and the value will be lower when compared to current scenario, that is with synergy with company A. Suppose this division is getting demerged into company B, which might have altogether a different level of synergy. So will we have to adjust the projections, or will so what would be the basis of value for division B? Will it be on standalone basis,
In
or
my view, if this division has to be seen the way it is, and on demerger, the division is not going to enjoy the synergies post demerger, then one will have to consider it on a standalone basis without the synergies, because we are saying the division, if it is on a standalone basis, if it was in a separate company, it would have not enjoyed the synergies. In my view, it should not be captured while arriving at the valuation.
and if suppose currently in company A it has 100% of synergy, the entity which it is getting demerged, it might have a lower synergy, suppose 50%. So will that 50% have to be considered, or only the standalone
It is post
value?
merger, so that is because post merger will enjoy that 50% synergy, right?
Right.
So it should not be considered.
Oh, thank you.
Yasin, to reply to your question, final ratio may be different in the market.
Yeah, so the reason for asking that question was more to understand from a risk perspective, post the ratio getting declared of two listed companies, obviously the market is also going to take cognizance of that fact. So from a risk perspective, as a valuer, is it safer to say issue a report using only the listed price, assuming the prices are indicative of the fair value, or as you said, to include another method? And in that case, what may happen is, to the extent of using the other method, the ratio will be different than the market price.
Yeah, it could be different. So see, I don't have any practical example to quote, but say there is a two listed entities are there, in which case, in case of B Limited, it holds, say, shares of another listed company to a significant extent. Now, sometimes the valuation market price of B Limited may not capture the underlying value of that listed subsidiary or listed operating entity. So it becomes very critical to do a cross check based on other method, and maybe that the other method may throw a different price altogether. But and in that case, the ratio may be different than the market prices. Now, generally, what I have seen is most of the cases practically is people try to be closer to the market price, but I'm sure there will be instances where there is a difference in the ratio given as compared to the ratio based on market price, and post announcement, the market prices adjust themselves. I'm sure there will be examples of such cases. Let's come to the next instance of group company merger. Now here, when I'm talking about group company merger, I will be more referring to closely held companies, private limited companies, where the companies are held by similar same family group or something. Now, whether it is okay to just use a NAV method to recommend a share exchange ratio. What is everyone's view on this? Any views? In my view, it may not be appropriate just to use a NAV method. Yeah. So NAV is okay, obviously, if it's an investment company, but you will have to fair value the underlying investments. When I say NAV method, I was more about referring to just using the book value of assets and liabilities. Or maybe not for an investment holding company, just using NAV method as it is without adjusting for the underlying investments. Now, in my view, it will not be correct as a valuer to do it, because one is the ICAI valuation standards do not permit just use of NAV method. The standards specifically say that one needs to consider all the approaches and methods and determine which are the approaches or methods more appropriate for the valuation of the company, and then use it for valuation. So if we are just using an NAV method, it may be difficult to justify why you are not using maybe a DCF method or a CCM method in such cases. Coming next. So if there are two companies having mirror image shareholding, Devrajan, ideally, I may also go to the extent of saying that I need not do NAV as well. I may say there is a mirror image shareholding. So whatever ratio we recommend is okay, because the beneficial ownership of the shareholders remains the same in the transferor company as well in the transferee company. I may not even get into NAV method at all. The same logic which we can apply for a plain vanilla demerger case. Coming to market price method for listed companies. Now, first question is the duration or the period for which the market price needs to be considered. Now, yeah, so if the RD asks for a for the purpose of coming back to Asim's question on group company merger, if the RD asks or the stamp for stamp duty, if there's a valuation working required, maybe a separate valuation working can be done and provided separately to the company. However, the recommendation of ratio need not be based on the NAV method. What I meant to say, you can always do a separate valuation and give it. But even the stamp duty authorities nowadays, Asim, my practical experiences, they don't go by NAV values generally. They also want proper valuation. Okay, coming back to the point on market price, what is the duration and the period up to which the market price needs to be considered? Again, here there are different practices followed by different firms. Some consider 6 months period, some consider 3 months period. In fact, now the certain firms are even using the 90 trading days based on the ICDR pricing formula, which has been recently amended. Now, and the second aspect is how does one consider the market price? So again, there are two practices here. Some firms follow volume weighted average price, which is like if you have if you're considering a period of 3 months, you will take the total turnover of 3 months and the total volume for 3 months and arrive at the volume weighted average price. There are some firms who are taking an average of daily volume weighted average price of maybe 6 months, 3 months, or 90 trading days, and then arrive at the market price. So there is no one approach which is consistently being followed. Neither there is any recommendation or there is any guideline on this at what should be the way of computing the market price. But one should keep in mind it should be a longer duration. It should not be like 1 week or 1 day market price that one should take into account. The second is the date up to which the market price needs to be considered. This is very critical in case of listed company mergers. Now here, there are two practices. One is first instances where the company makes a two-stage announcement. The first announcement, the company will say that, okay, they have given an in-principle approval of merger of A Limited into B Limited, and the committee has been appointed to take care of the appointment of valuers, agencies required for drafting the scheme, and so on and so forth. Then after a few days, they will announce that the board meeting will be held after 2 days to consider to approve the scheme and the ratio. Now, in such cases, the valuer needs to read the announcement, the language of the announcement, how it has been worded, and also look at the price movements post the first announcement. Most of the cases, generally, the price for the market price needs to be considered up to the date of the first announcement. As it is available, as the knowledge is come into public domain that the two companies are merging, and the market price would react to such information. So to remove that impact on the market price, one should generally consider market price up till the date of first announcement. However, say the way the announcement, if the announcement is a case where they are saying they are evaluating whether they will merge or not, maybe in such cases, one may take a view to say that we will take the market prices up to the date of second announcement. But as I said, one should look at the market price movement post the first announcement and then take a call. The second instance is where the company just makes one announcement, which is 2 days before the board meeting, saying that a board meeting will be held to consider the approval to approve the scheme of merger between A Limited and B Limited and approve the share exchange ratio. There it is very clear. The market price needs to be computed up to the date of the announcement. In this case, there are no two announcements, there is only a single announcement. Coming to the face value of shares of transferor and transferee company, if there is a difference in the face value of shares of transferor and transferor company, will there be any impact on the share exchange ratio? Would anyone like to answer this? Yeah, Devraj and Payal both have said that it should not have any impact. Yes, difference in the face value of shares of transferor and transferor companies has no bearing on the valuation ratio. So if you go back to our example, which I discussed earlier, on the left side, if you see that company B, which is the transferee company, has a face value of 10 rupees per share, and company A has a face value of 100 rupees per share. However, both the face value, both being different, does not have any bearing on the ratio. The ratio is totally based on the relative value worked out by the valuer. Now coming as a valuer, whether a single ratio is more appropriate or one should give a range of ratios. Now, here over a period of time, what has happened is valuers have been giving only a single ratio. If you remember, I just gave you an example of a case of earlier, that there were 3 valuers appointed and 3 ratios were allotted, given, and then the board averaged it was challenged. I think so somewhere after that, there is a practice of giving a single ratio, even if there are 2 valuers. The ideal situation is that both will arrive at a consensus and give a same ratio. There cannot be a range of ratios, otherwise it can be easily challenged by the shareholders, saying that the board has been biased to select a particular ratio out of the entire range. Now, bonus and split, how does it impact the ratio? Let's look at 2 instances here. First instance, you are carrying out the valuation, and before the issue of the report by the valuer, the company announces a bonus or say maybe split in the face value of shares. What do you do in such cases? One is, it has been announced, but the record date is post the date of the board meeting in which the scheme is being approved. In such cases, as a valuer, you should give 2 ratios. One is, what will be the ratio before the bonus or split, and what is going to be the ratio if after the bonus or the split. Now let's look at a second instance where you are doing a valuation and you are supposed to issue a report tomorrow. And on the day of the board meeting, the board announces a bonus or a split. Then what do you do in such cases? Now, mostly in case of listed companies, the valuer will never be aware of this proposal of bonus or split because it's a price sensitive information. And generally, it will not be disclosed to the valuer that the company is proposing to have a bonus or a split. In such case, the report which is submitted to the board of directors will be based on a pre-bonus split. In such cases, the company will approach the valuer again and ask for an addendum to say that please give us a ratio based on post bonus and split as well. And as a valuer, you will need to give this addendum because otherwise the stock exchange will not approve the scheme. The next instance is, say, for a demerger, where there's a demerger of an undertaking of A Limited into a into a new co, where the new company is not yet incorporated. Can we give an exchange ratio in such cases? Asim is saying no. Anyone else has a contrary view? Okay, so Asim, there have been practical cases in the past where there is a proposal for demerger of an undertaking of a existing company into a new company, and the new company is not incorporated on the day you issue a report. In such cases, still a share exchange ratio can be recommended, where you will look at the draft scheme, look at what is the proposed capital structure or paid up capital of the new company that is being proposed. You can take a management representation letter which will mention that the new company will be formed with so and so share capital with so many shares and what will be the face value, and the exchange ratio can be recommended on those basis. Obviously the report will mention that this is yet to be incorporated, and considering that the share capital is so and so, the ratio will be so and so. So in case there is any change in the share capital structure of the newly incorporated entity, obviously the report will, see the value of the new company will be face value. So there are a couple of cases which have happened. I don't remember in the listed space, but definitely in the unlisted space. In such cases, what happens? By the time the scheme is implemented and approved, the new company is incorporated by that time. Even in case of listed companies, there was this case of NDTV, but I think so the scheme was withdrawn. And there was scheme of, I think so, Raymond also. Again, that scheme was withdrawn for various reasons, but even there, I think so, there was a demerger into a new company where the new company was not incorporated on the date of issue of the report. So obviously, one needs to take all the representations in such cases on from the companies. The next point is in case of where the unlisted company shares are to be allotted pursuant to merger or demerger. There is no specific requirement under Income Tax Act to carry out the valuation of shares. However, we have in recent, after this 56(2)(10) and 56(2)(7)(b) has come in, we have been asked by the companies to even provide the value of shares of the transferee company under Rule 11 UA. Maybe there is some view taken to say that there could be tax implications. In such cases, maybe they are just taking the report to say that the issue of shares which have been made is above the value of shares under Rule 11 UA. But it's more from tax perspective that these valuations are required. So one should keep this also in mind. So Payal's question is whether a new report will be required once the new company is incorporated. It will not be required as long as whatever share capital you have considered for the purpose of ratio is same when the new company is incorporated. It will not be required. Under the Companies Act, no. Now, coming to on merger and demerger, when I was explaining you earlier, we have said that the transferee company will issue its shares to the shareholders of transferor company. Now, there have been instances that apart from equity shares, sometimes as a consideration, there are redeemable preference shares, cash, convertible instruments as well. Now, what does one do in such cases? Here, to some extent, the relative value concept will fail. Say, for example, we'll take an example that company A is merging into company B. company B is going to issue redeemable preference shares. Now, in this case, for arriving at the value of redeemable preference shares, one needs to look at the terms and conditions of the proposed preference shares. So one should look at the draft scheme, look at the terms and conditions. One should obtain a management representation letter as well to say that what are going to be the terms and conditions of this new redeemable preference shares, and also mention the terms and conditions in the report, that these are the terms and conditions based on which this preference shares will be issued, and carry out the valuation, and based on this value one will recommend the share exchange ratio. Now we have discussed up till now merger, demerger. Now one thing which is very critical is sometimes the transaction involves multiple steps. There may not be a simple merger. There could be merger and demerger both together. There could be capital reduction and merger or a demerger. There could be preferential allotment and a merger or demerger. So how does one take care of it while carrying out the valuation? So I have just put 4 instances here. There could be multiple instances, but I have tried to cover 4 of them here. Now here one is very critical, is that one should always read the draft scheme to see that whether what is your understanding and what is mentioned in the scheme is same. There's no difference between the two. It is very critical for the valuers to always obtain a draft scheme of amalgamation from the companies before issuing a valuation report. Now let's look at the first instance. Now here we have 2 companies, A Limited and B Limited. Here, as part of the same scheme, there are 2 steps involved. The first step is B Limited is proposing a preferential allotment of equity shares of B Limited, where it is going to give this allotment to promoter company of A Limited as well as the promoters of B Limited. And post preferential allotment, there is going to be a merger of A Limited and B Limited. So obviously step 1, if B Limited is an unlisted entity, one will do a normal fair valuation to arrive at the per share price at which the preferential allotment needs to be made. Now when you come to step 2, which is merger of A Limited into B Limited, A Limited, you will do the relative value per share. While determining the relative value per share of B Limited, one will have to give the impact of the preferential allotment. So you will add the proposed cash infusion which is happening and divide the value by a diluted higher number of shares post preferential allotment, and then recommend a ratio. One example of this which I can give is of the recent announcement of merger between Z Entertainment and Sony Pictures, where there is combination of preferential allotment, bonus split prior to the merger. So similarly, say instead of preferential allotment, there is a capital reduction whereby the number of shares of say B Limited are getting reduced. Then on second step, when there's a merger, one will have to arrive at the relative value per share of B Limited after considering the capital reduction. Let's look at second instance where there are 2 steps again. First, there is a merger and then there is a demerger. So we have P Limited and Q Limited. There is a proposal to merge P Limited into Q Limited. So Q Limited will have 2 sets of shareholders post merger. One is its own shareholders plus shareholders of P Limited. Now post this merger, there is a proposal to demerge a division to R Limited. Now here R Limited is a wholly owned subsidiary of the merged entity, and on demerger, R Limited will have to issue shares to the shareholders of the merged entity, not just to the shareholders of Q Limited. So R Limited will issue shares to the shareholders of P Limited and Q Limited. So in this case, since merger has happened as a first event and demerger is a second event, though forming part of the same scheme, at the time of recommending the ratio for the demerger, R Limited will issue, you will have to give a ratio whereby R Limited will issue shares to the shareholders of P and Q both. So you have to look at the post-merger share capital of Q Limited. You can refer to the scheme of Aditya Birla Novo and Grasim Industries, which was there in 2016, where a similar facts were involved. So if you look at the resultant structure, you have merged company Q Limited, which is the residual Q Limited, which will have shareholders as its existing shareholders and shareholders of P Limited. And R Limited, which is an entity post demerger, again will have two sets of shareholders. Now we will go to a case which is a reverse of this, which is there is demerger first and then there is merger. So how will the resultant structure look like? How will it have an impact on the valuation? If you look at step 1, there is a demerger of a division from P Limited to R Limited, and R Limited issues its shares to the shareholders of P Limited. Post this demerger, the residual company P Limited is merged into Q Limited. Now here, when arriving at the valuation of say residual P Limited, one needs to exclude the division which is getting demerged. Only the residual business needs to be valued to arrive at the relative value per share of P Limited to recommend the share exchange ratio for the purpose of merger into Q Limited. Say in this example, if P Limited was listed, whether one can consider the market price method in step 2, you will not be able to consider the market price method in step 2 because in the step 1 there is a demerger of a division that has happened, and therefore the market price will not be relevant for the second step. Now here, if you look at the resultant structure of R Limited, it has only shareholders of P Limited. So if you see the difference between the step two instances, first was merger and demerger, where R Limited had two sets of shareholders because there was a merger first. However, in this case, there is a demerger first, and therefore R Limited is only P Limited as shareholders. Any questions so far? Okay. Now this is again a very peculiar case, not very regular cases which you will see practically. So here we have E Limited and we have G Limited, which is a wholly owned subsidiary of F Limited. E Limited is proposing to demerge a division into G Limited, but instead of G Limited issuing the shares to the shareholders of E Limited, F Limited is going to issue the shares. F Limited, being the holding company of G Limited, is going to issue shares to the shareholders of E Limited. So for arriving at the share entitlement ratio, which are the two, which is the entity that you will value? Whether you will value G Limited or whether you will value F Limited. Anyone would like to answer this? Okay, so here, yeah, so Devarajan is right. Since F Limited is issuing the shares here, one will, though the demerger of the division is happening into G Limited, F Limited valuation needs to be carried out, which will in turn capture the value of its wholly owned subsidiary. So then post resultant structure will be F Limited will have two sets of shareholders. One is its existing shareholders plus shareholders of E Limited. This brings me to the end of the session. If anyone has any questions, and we can discuss that.
So, Bhakti, would it be possible for you to throw some light on, how the accounting policies of both companies should be seen, merging as well as the transferee as well as the transferor company?
So generally, I think so. The one of the major difference which sometimes comes is that one company is following Ind AS accounting, whether the other company is still following the normal accounting standards. Now, if that is the case, then one needs to realign the company which is following the normal accounting standards to convert the accounts into Ind AS and give it to you. Apart from that, there may be some differences, I don't know, maybe in depreciation policy or in case of amortization of some expenses. Then one needs to realign those things before and give that impact in the valuation for arriving at the share exchange ratio.
All right.
I hope I've answered everyone's questions in the chat box. I don't know if I've missed anything.
Yeah, so
Anyone?
I think there don't seem to be any questions. So we can
Okay.
maybe close.
Sure.
I don't think
Fine.
Rashmi is there today, is it?
She's there, but I think so she was facing
I'm
some
there.
issue.
I'm there. I'm
Oh,
All
there.
right.
in between she was facing some issue.
Yeah, I logged off and logged in then.
Okay.
Yeah.
So I think so. Not many questions. So we can wind up then.
All right.
Thank you, everyone.
Thank you, Bhakti.
Thanks, Asim. Thanks, Rashmi.